information, and most of this information is in public domain. It is there on the websites. So once again, I would like to reassure through the media that investors' money in credit risk funds is not at any significant risk even in these challenging times. I think the quality of the portfolio at the industry overall is very good. The regulators have taken a number of steps, and it is reasonable to expect more steps to be taken by the regulators as we go forward. I would also like to mention that the entire credit risk fund category is barely 50,000 crores. The total market debt funds that we manage in the industry is in the region of about 10 lakh crores. So the credit part of the fund industry's business is barely or less than 5%. So we do not see this as an industry problem. We do not see what has happened as a category problem. So actually, we believe that most of us in the industry are well positioned to deal with the ongoing challenges that are there. We do believe that the portfolios are of high quality, and with the measures that both the RBI and SEBI is taking, we remain confident that we should be able to meet any kind of redemption request that comes. On the contrary, if you look at what is happening in the credit markets, the credit spreads, the yields that are available on extremely high quality paper as well as some of the credit papers is very attractive. So this actually becomes an opportunity even for people to consider tactically putting in small amounts of funds in credit risk funds and not get carried away by what has happened between yesterday night and today morning. So in some sense, I would say it is business as usual. There is no need to panic. The industry has good quality of portfolio and with adequate liquidity being provided by the regulators, we should be able to manage the business as normal operations should be able to continue. I'll just hand over to my colleague, Bala, to speak further, and then we'll open up for question and answers.
Thanks, Milind. Thanks, Nilesh. As both of them mentioned, clearly it's an unprecedented time that what happened yesterday, stopping the redemptions, is something which generally doesn't happen. But having said that, as others mentioned, that the mutual fund industry manages close to about 15 lakh crore in fixed income. The schemes that are generally in discussions on credit is only about 2 to 3% of the overall the mutual fund debt portfolios, and rest of the portfolios are invested largely in the high quality securities, which those companies also have got equally high capability to go for a refinancing either from banks or from other sources of financing. In general, these investments are having a high credit rating as well as high liquidity. I think the mutual fund industry also has gone through the tough period of from 2018, from the time the credit crisis started happening. I think MF industry players, money managers have become extremely cautious in building the portfolios, and in order to keep in mind, one, the safety element, second is the liquidity element, and third is the return element. On the basis of this, only under these principles, portfolios have been constructed across fund houses. As everyone mentioned, that of course one has to look at individual fund houses portfolios and form an opinion on individual portfolios. Having said that, I would like to also mention that most of the portfolios have got reasonably good liquidity papers in the portfolio. In fact, even the LTR was announced, that targeted LTR was announced for providing liquidity in the month of March by the Reserve Bank of India, especially at a time where there was a lot of fear about liquidity in the market. And in fact, not more than 10,000 crores was utilized under the repo or long-term rate. Still 40,000 crores of amount still remains unutilized. Itself says that the liquidity of this thing is not an issue, and also from a portfolio point of view is something one should not have any concern about any potential credit-related issues. And that's again small proportion of the overall asset management. And we also seen a similar situation in the year 2008 and post-Lehman Brothers crisis. Since then, I must also mention, purely on the basis of the way the industry has been managing the risk, both by the individual fund houses as well as guided by SEBI, as well as by the AMFI as a body, the management of portfolio construction has been pretty solid. And as a result of that, the industry size also today close to about 15 lakh crores is actually comes on the back of the fact that industry has been managing these portfolios quite efficiently over a period of time. Therefore, one-off incident, isolated incident, should not be considered as a negative for the debt funds, and that should not actually, one should not extrapolate this that will have an issue with everyone, and that's something I think we want to just convey. Having said that, I think Milind mentioned about retail investors no need to panic. In fact, no investor should take a negative view, whether it is HNIs, whether it is SMEs, or any other type of investor who would have come and put money in general fixed income schemes across different maturities, across different types. They should not unduly get worried on the basis of this one isolated incident. And third, I think one should also keep in mind that the liquidity is too much in the system today is available. As Nilesh mentioned, that close to about 5 to 6 lakh crore is going and sitting in RBI window at 3.75, and RBI has taken in the second version of the stimulus they give, they further improved actually the LTO money available in the market, and they also said very clearly that any situation that arises, the Reserve Bank of India will provide more liquidity in the systems and more support in the system. And keeping this in mind, one should not get worried about the liquidity of the papers that are held by the mutual fund players. Having said that, with the repo rate being at 3.75, and in fact there are no, the rates have dropped so much, I think by getting panicked, the investors only can get impacted after some time coming back for reinvestment. Therefore, staying invested, staying calm, having confidence on the debt funds or mutual funds, I think would be key. And that's, I think, we want to actually convey as an AMFI, as a body, having analyzed the portfolios and also having seen what kind of impact it could come, and that we want to just convey. With this, I'll stop and hand it over to Venkatesh and invite questions from all of you.
Thanks, Bala. Thanks, Milind. Thanks, Nilesh, for the briefing. We will now open the floor for questions and answers.
Hello, sir, operator here. Shall we start?
Yeah, just ask them to also state their publication, or channel.
Sorry, sir?
When you open it up for questions, tell them to also mention their publication or channel.
Okay, yeah, sure.
Yeah.
Dear participants, if you have any questions, kindly press star and 1 on your keypad. I repeat, dear participants, if you have any questions, kindly press star and 1 on your telephone keypad. So the first question comes from number 9769383356. Please introduce yourself and go on with your question.
Hi, this is NICKEY from BloombergQuint. Am I audible?
Yes.
Hi, sir. Sir, I actually have the first question for Nilesh, sir, where he said that more regulators need to do more, especially for NBFCs. Could you highlight what are your expectations? What can be done towards NBFCs?
So, Nikki, if you look at NBFC, they are spread across credit spectrum. There are some AAA rated NBFCs, some AA rated NBFCs, some single A rated NBFCs, some probably even lower. And clearly today, credit flow is available from capital markets to higher rated NBFCs
where majority of mutual fund portfolios are invested into. But my comment was more generic from an economy point of view. We just need not take care of highest credit rated companies. We also need to ensure that credit is available at the lower end of credit curve also. While mutual funds don't have exposure over there, as our portfolios are geared more towards higher credit quality assets, they do play an important role in the overall credit delivery to the bottom of pyramid, to the small and medium enterprises. So keeping the work they do for the economy, there is probably need to ensure that credit transmission to them also happens. We did see in the TLTR of our NBFC sector that the response was less than anticipated, and hence there is some need for work to be done.
Sure. I also wanted to confirm with you one more thing, one more fact before I move on to my other question. Sir, you said the credit risk fund exposure overall is around 5.9% of aggregate debt AUM. Have I got that correct?
Yes.
Okay. Sir, I also, the next question that I have, in fact, is for Milind, sir. He actually gave out a breakup of the credit risk fund where he suggested that, 30 to 50% gets invested into AA plus, AA plus. If you could just highlight that bifurcation once again, that will be really nice, sir.
Sure. So what I mentioned is that the credit risk fund is generally perceived by the way the name reads. But the reality is that even in a credit risk fund, most of the credit risk funds in the industry have, and this is I'm taking from data as of 31st of March, which is in public domain, between 20 to 30% of credit risk funds have AAA exposures and some amount of cash. Then it has another about 35% in AA and another 30 to 50% in minus, AA minus, AA and AA plus. So if you just take the AA category, almost 60 to 70% of a credit risk fund actually has a reasonably high quality of AA and above paper in the credit risk fund. And therefore, sometimes one believes that the credit risk fund name seems to communicate an impression that everything in that credit risk fund is very vulnerable to credit events. The reality is not so.
Okay, so below AA, what's the percent like?
Below AA minus would I don't have the exact data. My sense is it will be hardly maybe 20%.
Okay, all right. Thank you, sir. Thank you.
So the next question comes from number 9850-834528. Please introduce yourself and go on with your question.
Hi, this is Neil Borate from Mint. Hello?
Please go ahead.
Right. I have two questions. My first question is that this instance demonstrates, as have previous instances, that credit risk is not confined to the category labeled as credit risk fund. There have been funds also in the ultra-short category or low-duration category which have been affected. So is there a call for SEBI to relook at the classification that it has made? So that's my first question.
Venkatesh, you want to answer?
Nilesh can answer.
Okay.
If we see the current classification, by and large, it does hold well. Now, every debt fund has three kinds of risks: credit risk, liquidity risk, and interest rate risk. Even when you invest in government securities, which by definition has zero credit risk, it does carry liquidity risk and interest rate risk. When you invest in AAA rated paper, by definition it carries lower credit risk, but it doesn't carry zero credit risk. So we must appreciate that there is no free lunch. Every debt fund generates return by managing credit risk, liquidity risk, and interest rate risk. And in some cases, we have seen credit risk percolating in isolated non-credit risk fund also. But if you see overall percentages of mutual fund vis-a-vis its peer group, we have by and large managed our portfolios in current challenging times with bare minimum credit risk. Our transparency is visible to all, and we have ensured that day-to-day operations of mutual fund industry continues to function through the ups and downs of the market, including 2008 subprime crisis, 2013 taper tantrum crisis. So at this stage of time, obviously, we believe there is fair amount of disclosure to investors in terms of what kind of risk is taken by each fund. There is also combination of riskometer which is being published for each fund. And clearly, if there is any feedback from investor or distributor community to improve it, we'll be open to it.
Okay, so AMFI can consider a relook at some of these category definitions?
Neil,
if there is feedback from...
I work very, very carefully. If there is feedback, we'll be happy to improve from our current positioning.
Okay. My second question is about the current negative net cash position in various schemes. I believe, Nilesh, you mentioned earlier in maybe a TV interview that right now there is no negative net cash position in any of the schemes. Is that so, or there's some remaining negative net cash?
Neil, you must appreciate that we are in the process of collecting data. SEBI NC had sent out this note, this email to all the members yesterday night. And so far, whatever responses we have received, majority of them have confirmed that there is no borrowing across any of their schemes. But give us some time, we will collect and give you exact details. But you can rest assured that majority of fund houses have confirmed that there is no borrowing across their schemes.
Okay, that's it from me. Thank you.
Venkatesh, as soon as we get the details, can we send a press release that this is the exact borrowing for the mutual fund industry as of yesterday?
Yeah, we can. The moment we finish collecting, we can even put it on our website and give a small press release to all the people.
Perfect. Thank you.
Thank you.
So the next question comes from number 9820231186. Please introduce yourself and go on with your question.
Hello. Hello, is it audible?
Audible. Please identify yourself.
Yeah, this is Narendra Nathan. This is Narendra Nathan from Economic Times Wealth. My first question somewhat is already answered, basically about fund houses. Some fund houses taking extra credit risk with other funds. Credit risk funds are fine, so that is one part. Other thing, do you see any chance of this risk now with the lower rated papers spreading into higher rated papers? Because there will be some redemption pressure and then maybe the mutual funds will be forced to sell in the market. So is there any chance of that spread happening?
Ala, you want to take that?
Yeah. No, I think the way things have been evolving the last few weeks, post Reserve Bank of India reacting and providing liquidity to the bond market, we have seen a significant rally that has happened for all those instruments which are the AAA and even AA plus. And most of the companies who have been in the market actively, which are held by the mutual funds, are also equally eligible for refinancing from the bank's window under the targeted long-term repo that has been introduced. And some of the primary issues of those bonds are also getting subscribed at reasonably good rates. Therefore, we don't see the current issue during the low-rated issue that we are referring to getting migrated to other securities. And even the month of March, when there was selling pressures in the market for rising liquidity, and money are getting absorbed, the sales are getting absorbed at reasonably good yield, and they had an impact for a few days in the liquid fund generating negative return because the yields had shot up. I think post LTRO introduction, definitely a lot of calmness has come. Also, Narendra, we look at it from this in the angle of the kind of liquidity that is lying in the RBI systems of under the repo window. A huge amount of liquidity is available, and today it's also equally a problem for deployment for banks and players in the market. Therefore, this current isolated incident should not really impact the yields to shoot up, and we also don't feel, even from investors' point of view, they should not get much worried and look at redemption as an option. That also there is no need to do it. Given the fact that, as explained by all of us, the existing portfolios are not only good, and the portfolio liquidity is also reasonably good, and the fact that Nilesh also mentioned earlier that none of the mutual funds have got any outstanding borrowing as of today, also it indicates that so far MF industry has been managing the portfolios quite well. You can go next question.
Yeah, okay, thank you.
Yeah, thank you.
So the next question comes from number 1130-814040. Please introduce yourself and go on with your question.
Hello, sir, I'm Chirag from the Financial Access newspaper. Sir, just wanted to understand, you spoke about, RBI and SEBI are helping the industry. So just wanted to understand what kind of help do you want from the RBI and SEBI in this kind of situation?
Yeah, I think maybe I'll take that. I think so far both the regulators have done reasonably good support, good for providing necessary support in general to the capital market for debt capital market, and second, providing liquidity in the banking system. I think what I mentioned about 5 lakh crore liquidity that is lying in the RBI, close to that amount lying in the RBI window, is an outcome of various steps that is taken by the Reserve Bank of India. Of course, the more thing that can come, as I mentioned earlier, that the targeted repo window has been provided by RBI. The initial reaction from the banking industries were those are availing this benefit from RBI window. They were sticking to buying only the securities which are AAA and PSUs kind of names. Probably as we go down the credit lines to investment grade, naturally it will provide necessary liquidity to the capital market in general, and the ability for companies to borrow at reasonably good rate, especially when rates are falling, may also actually do a lot of good. And finally, it will also actually improving in the rotation of money into the system per se. These are the only things probably one can expect to happen. But of course, it has got nothing to do with the Reserve Bank of India. It's more about risk aversion that generally people carry. Given the high liquidity that is lodged in the system, we would assume that as the times progress, we'll probably see a participation coming in the segment as well.
Okay. So second thing was, after what will be the impact of this event, and how do you see the redemption pressures in the mutual fund industry in the days to come?
I think, Nilesh, yeah.
If you help us communicate our credit profile and our liquidity profile to our partners and our investors, then I see our business continuing on a normal basis. This is not about lack of cash at the mutual fund industry. What has happened is an isolated event. As I mentioned repeatedly, majority of mutual funds from whom we have received confirmation does not have any borrowing whatsoever in their portfolio, even though they are permitted to borrow 20% of their AUM for repayment and dividend obligations. This clearly shows that there is no dearth of liquidity in the mutual fund industry. Second question then comes onto the credit risk side. Again, if you look at the credit profile of majority of mutual funds, whose bulk of money, more than 90% of money, is in non-credit risk fund, Majority of investment is in superior credit quality papers, including treasury bills, government securities, state development loans, certificate of deposits from banks, and public sector undertaking bonds, where credit perception hasn't deteriorated at all despite current situation. Bulk of the investment in the residual category also is towards AAA-rated corporates, many of whom have raised capital under LTRO process, LTRO operation in recent times. Third comes on the interest rate risk side, where in the month of March, we did see some liquid funds giving negative return for a very few days. But on 27th March, when RBI intervened in the market with liquidity enhancing measures, with interest rate cuts, and with reassurance about necessary action going forward, the same liquid funds delivered in one day what was due over the previous 5 days and compensated for the negative return of those few days. So whether we look at current mutual fund portfolios from liquidity side, credit profile side, or interest rate risk side, there is no cause for people to be unduly worried. And as long as you help us carry this message, which is the purpose of this call, I'm sure they will be able to keep their confidence and trust in mutual fund industry like before, and they won't have to change their financial planning. They won't have to deviate from their investment in mutual funds.
Thank you, sir.
So can we move on next question?
Yeah.
So we have next question from mobile number 9833043598. You are unmuted, sir. Please go ahead.
Sir, this is Suresh from Business Line. First, I would like to understand whether banks are willing to lend to mutual funds. You talked about ample liquidity. Are banks willing to take the risk of lending to mutual funds? And also, given this current economic situation, how do you see corporate bonds abiding by their, do you see any default in corporate bond side?
Bala?
Yeah. I think on the first question, Suresh, banks have been providing liquidity. I think in the month of March, some of the fund houses had to, of course, take the route of borrowing to make the redemptions. And all of them actually could meet that by taking redemptions, by meeting the redemptions through the borrowing. And banks, each fund houses, on the basis of the size of the funds and the liquidity requirement of the funds and nature of the funds they run, we do have a line of credit with every bank, pre-closed line of credit they have. Therefore, the borrowing of 20%, which is defined by SFB, for making any redemptions is not an issue. I think that's on the basis of past experience, and with the current liquidity that is being there, again, is not an issue. With respect to any kind of defaults, I think we need to, of course, pay attention to what Reserve Bank of India had given. During the period of COVID lockdown, they have given exemptions for any kind of moratorium or payment or any delay that happens on account of COVID-related issues. It should not be seen as default, and that should be any restructuring can also be done by the banking industry. That being the case, one should not expect any knee-jerk reaction coming from rating agencies of putting the rating under the watch list or downgrades, and also push companies actually for any kind of default as a result of that. So we don't see that happening. Even SEBI also has come with a series of measures with respect to the guidance to the rating agencies, as well as the guidance to the valuation agency. All of them are actually pointing towards and ensuring the necessary support is provided during this point of time to ensure that no knee-jerk reactions lead to some kind of accidents. So I would assume that at the broader level, what you're expecting may or may not occur. But of course, individual companies who have been in stress for, say, before the COVID period kind of thing, of course, one doesn't know actually what could potentially happen there.
So you said yesterday night you had given a call for collecting outstanding data from mutual funds. So how many of them have responded, or?
We will put a press release as soon as possible once we are out of this call and we have collected all the data. But lot of them, bulk of them have replied back saying that there is no borrowing.
Okay, sir. Thanks. Thanks for that.
So shall we move on next question?
Yes, please. Yeah.
So next question we have from mobile number 9820889109. You are unmuted, sir. Please go ahead.
Hello, I am Nilesh from Money Control. I have only one question. What is the prerequisite for winding up of schemes? Is it approval of trustee and approval of unit holders, or I'm to say the norm is either of these two, or both of these things are required?
Venkatesh, Bala, do you have any idea about it? I haven't studied the regulation.
No, I think even I'm not clear about the regulation. My sense is that it is a decision of the trustees.
Can we consult our compliance team and come back to you with proper answer? My apologies, we are not all up to date about the regulation. We should have been, but since we have never considered winding down, we are less informed about it. But I will ensure that one of our compliance officer gets in touch with you and give you the correct positioning.
Oh, thank you, sir.
So we have next question from mobile number 9920576476. You are unmuted, sir. Please go ahead.
Yeah, sir. Josh here from Business Standard. Actually, a couple of my questions I had for now have been answered, so I'll see if I need to come back in the queue. Yeah, thank you, sir.
Thank you, Josh.
Thank you.
Thank you.
So we don't have any further questions, sir.
Okay.
Yeah. Okay. Thank you.
Okay, thanks.
Thank you. Thank you.
Hello.
Participants, this